Hello traders, welcome to a new video here on the channel. So today I thought I would try to make a little special video on a new topic that I haven't talked in the past before, and this is the use of common gaps and how I use them in my trading. So if you're familiar with my trading style with price action and volume profile, you'll know that I place a lot of emphasis on common gaps, especially to set take profit target areas and also to look for areas for entries when I am trading. So I figured this video I will do it more sort of as an improvised video, just explaining my thoughts and things as we go. I'm gonna talk about the four main types of gaps that we have in trading, and I'm gonna specifically focus on the common gaps, which is the ones that I use most when I'm trading on lower time frames, when I'm doing my intraday trading, especially in the futures market that I'm most active in. Okay, so first thing, I'm just going to go to investopedia.com. If you're not familiar with this website, this is a pretty good reference website if you want to just look for general concepts or definitions of different various concepts when it comes to trading. I wanted to just go over the gap definitions here because I didn't want to have to do a really long PowerPoint presentation like I normally do, because then that will mean the video would come out later. So I just wanted to bring you something today. So I figured I would just use Investopedia as a reference for the theory, and then we're going to jump into the charts. So in general terms, we're going to see first, so what is a gap? So in general terms, a gap is an area discontinuity in a securities chart where price either rises or falls from the previous day close with no trading occurring in between. This, as we're going to see later, doesn't necessarily mean just between daily closes and opens. Gaps are common when news causes market fundamentals to change during hours where markets are typically closed. For instance, earning calls after hours. So this is more of a definition geared towards traders of stocks and equities. But basically, a gap, what does it tell you? Well, it tells you when there's a piece of news or event that causes a flood of buyers and sellers into security. So basically, when a gap occurs, you got a shift in liquidity, volatility in a security where price moves in a direction really quickly, and then you can see on the chart either a empty space between two candles closes and opens, or just, as we're going to see on certain instruments, is just a big solid large candle, like an impulsive move, which means that there was just a low liquidity environment and price just moved really quickly from one level to the next. So there's four main kinds of gaps, as we're going to see. In general, the common gaps generally get filled relatively quickly, usually within a couple of days. This don't necessarily need a major preceding event to happen compared to other gaps. They're also known as an area gap or trading gaps, and tend to be accompanied by normal average trading volume. So this is the ones, like the name implies, that are most commonly seen on the charts. I always identify them basically as a big impulsive candle compared to other candles, and this is what I use most commonly for my intraday trading. And then just for the sake of letting you know and explaining the other kinds, we have three other basic kinds of gaps. We got what we call a breakaway gap, which is when price gaps above a support or resistance area. For example, if we're in a trading range and then price breaks out of that trading range, that's considered a breakaway gap. Also, when price breaks out of a price action pattern, like a triangle, wedge, etc., head and shoulders, we can say that that's a breakaway gap as well. A runaway gap usually occurs once there's already been a breakaway and price is trending either up or down. So the runaway gap is usually driven by intense investor interest. So if we have an asset that is really going up strongly, then people are getting FOMO. There are people that are just buying in and in because they don't want to miss out, and it just keeps pushing the price up really quickly. So that is creating runaway gaps. And finally, we have the exhaustion gaps, which is a technical signal marked by a break lower in prices, usually on a daily chart, and it usually occurs towards the end of a very strong trending market. So after we've had like runaway gaps, basically the exhaustion gap is sort of a final gap after runaway gaps, where we see just the final participants that are just completely FOMOing into an instrument, pushing price to either extreme new highs or lows, and then usually this signals a shift in the sentiment between buying or selling activity, and then this indicates that in this case the upward trend may be ending soon. Each type of gap has certain consequences for traders, so you can use them either for reversals or continuation trades, etc. So we have some examples here. I'm just going to briefly go through this and then I'm going to jump on my own charts. So for example, this is a breakaway gap on Amazon here, where they show where price is just consolidating here, sort of on an ascending triangle, and then we just break out. There's a clear gap, and then we just continue going higher. Let's go now to my own charts, and I'll show you some examples of this. And I actually have a screenshot I took here. This is a stock. This is the Activision Blizzard one-day stock. So in the stock market, if you follow stocks, you're going to notice that there's a lot of gaps everywhere on the chart, usually between daily closes and opens. You can see there's a lot of empty spaces here because the stock market is just open, for a few hours every day, from the opening around 9:30 a.m. and then closing around 4 p.m. Eastern time. So during the period that is closed, there may be earnings releases, there may be any unexpected news, and then that causes that the next day, as soon as we open, there's a big shift in sentiment, and it causes quick price movements, leaving this gaps here. You can just see it as empty spaces on the charts, but in this case what I want to show you is an example of a breakaway gap, where you can see clearly how we have this gray support level that has bounced prices a lot over the last few months here, and then finally over here we have a red day closing through it, and then the next day a big empty gap here, and then price just continues down. So this is a breakaway gap outside of this pattern. Now there's a saying that a lot of people, it's a common saying to say that gaps always get filled. While this may be true, when you have breakaway gaps and runaway gaps, this type of gaps can take weeks or months or even years to fill back up. Like if you see a long-term chart, for example, of the S&P 500, you're going to see that there's a ton of breakaway and runaway gaps that have just like not been filled in a very long time, for example. But like I said, I do mostly intraday trading, so my most useful type of gap, which I'm going to talk in more detail later, is the common gaps. But here I just wanted to show you, this is a gold chart daily. As you can see, we don't have any empty spaces in this chart. This is because this, I'm showing you the CFD. So CFDs are a derivative of like other markets. In this case, it could be a derivative of the futures market. And so in this case, this market is open 5 days a week, 24 hours a day, the CFDs, just like Forex. So we don't actually get empty gaps in price. What we do get is just impulsive move where we see very large candles up or down with no action in the opposite direction. So you can see here, for example, this is a daily chart. You can see how price is moving up here. We have a falling wedge with a very clear upwards trend line here acting as resistance, and then we have a breakaway gap over here. We can actually see how price pulls back perfectly to fill the origin of the gap. We fill it back up and then we take off. This is what I'm gonna talk later, how I like to use gaps not only for targets but for entries. For example, in this case, when we see price was coming down very impulsively, the first obvious target was the previous consolidation before the breakout in the pattern, or in this case from this pattern. Even if you zoom out here, if we would go into a lower time frame here, you can even actually see that not only is this a falling wedge, but on the lower time frames, this is a tiny ascending triangle as well. So you could see this was actually a breakaway gap out of two different types of patterns, depending on what time frames you were looking at. Okay, and then if we keep moving up here, we can see how we retest, we continue going up, market consolidates a bit, keeps going up, and then right here there's suddenly a huge buying interest. And for, in this case, we have 1, 2, 3, 4, 5, 6 for 7 straight days, buyers just push this market up. Even after we have had all this upside movement, we have a FOMO here where buyers are just stepping in and buying and buying. We're also very close to 2000, which, as you know, big round numbers are also a very important psychological levels, which you can see that we hit up here. And then finally we have an exhaustion gap, which is basically one last push, and then we have just a quick reversal, a quick fill back up, near, in this case, all near highs up here. And then you can see how the exhaustion gap is quickly filled back up. This usually looks like V reversals. And then we have the runaway gap filled right over here. You can see we did have a little reaction off of the consolidation before the runaway gap happened, but then this just pushed a little bit lower. Okay, so this is just a nice example of the three more long-term, let's say, types of gaps. Okay, so now let's go and focus. I'm gonna erase everything. Let's go and focus on what we would consider the common gaps. So for this, when I work with gaps, I usually, as far as my own trading goes, I'm mostly an intraday trader. I usually hold positions for no more than just a few minutes or maybe like an hour or two. So if we zoom in my case, well, sometimes I use tick charts. Other times I would use a 5-minute chart as my execution time frame. And then I use a lot the 1 hour time frame as sort of my higher time frame to identify trends that I can latch onto, and in this case targets for levels. So what do we define as common gaps? Well, common gaps are seen everywhere. In this case, I'm just gonna grab this marker. So anytime you see an impulsive move like this, where it just leaves like a little empty area here, these are all common gaps, where you have just an impulsive move in price where it just leaves a long candle or a long series of candles without any opposite reaction. Like in this case, you see we only had push up and nothing to fill down. In this case, we're talking obviously about the 1 hour time frame. So what I do is, in this case, and let's turn on our visible range volume profile, because common gaps are also associated most commonly with low volume areas. So these are areas where, since this is an impulsive move, we don't have a lot of consolidation at these levels, and this indicates low volume trading activity at these prices, since we moved so quickly through them. Like if I put this here and I just put this volume profile here, you can see how these are areas where we have cuts in volumes here, because as you know, volume profiles start accumulating size when we got a lot of trading activity at these levels. But if we have impulsive moves with not a lot of volume buildup, this is when we get this cuts in volume, and then these are areas that we get rejections in price. So what I do is I just look at these markets, and then, for example, let's say if I was trading over here and I see that price just starts impulsively coming down, then I would just mark the targets. I would just I would mark this as my breakaway point that formed this gap over here. In this case, this one, I mark this over here. No, not. I want to mark it with this guy, like that. Then here further down, I would mark this one, which I'm not sure if this has already filled. Yeah, it did fill here. So then, for example, as you can see here, just when we come down, you can see how all these gaps, in this case that I marked over here, they get filled back up. And once they get filled up, we usually have some kind of stalling in price. Usually, sometimes it'll happen, but it's not too common to just have a gap and have it filled back in and just have price break through completely, like in a single hourly candle. You usually get some kind of reaction off of these levels once you come back and fill them up. So what I like to do, if I see a trending market, if I see prices coming here and we're coming like this and we have a gap up, then what I will do is, I know that price, just by market structure, we're making higher highs, higher lows. So when price comes back to fill this gap over here that we left, what I want to do is look where the origin point of the breakout was, the consolidation in price, which usually coincides with a high volume node, or at least a small high volume node, because we had a consolidation before the impulse move. So then I look for these areas to buy. In this case, if we're on an uptrend, I will look for to say, okay, we made higher high, we have a higher low, now I expect another higher low, and I want to try to enter on the origin area, the consolidation before the origin of this gap up, and then I want to join in here. Usually these areas also will line up nicely with you can use confluences like Fibonacci levels. Usually these areas, if you can find confluence with like the 0.618 or even like a 75%, which is not really a Fibonacci number, but a 3/4 pullback. I really like the 75% pullbacks also. And then you obviously want to have it coincide with extremes on the volume profile. So just low volume areas on the edges, because as you know, I like to go in on trades on the edges of volume profiles, because the edges are where volumes cut off, and that's where we have the rejections in price. So let's go to another market. Let's go to Bitcoin. Bitcoin has a ton of common gaps everywhere. So let's just go to let's go to the Bitfinex chart. So you can see here, in this case, and again, this works on any market. I use this, I'll show you the S&P 500 later also. But as you can see, like on Bitcoin, for example, this here, let me put a higher time frame. This over here, we had sort of a breakaway gap here, because we had a clear resistance level and then we break out. So this is a breakaway gap on sort of a higher time frame, the 4-hour. So this, we expect is going to fill, but this can take a while to fill since we're sort of on a higher time frame over here. Okay, but again, let's zoom back in on the 1-hour. So then you can see how we have common gaps everywhere over here. We have this breakaway, we have this here, this here, this here, this here, 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 etc. So what I would do now, for example, in Bitcoin is I'm not gonna, and as you can see, common gaps fell back up pretty quickly. So this one, we had a gap here, fell back up. We had a gap here, fell back up. Gap here, filled. This one filled here. This one filled back here. In the case of this one, sometimes it's not gonna come all the way back, in this case to the red candle here, but it'll come back to just the previous swing high. So the last level where we had bearish or down movements break out, and then we come back, basically a resistance level now turned into support, and then we continue going. In this case, if I'm here, obviously my first target in this case will be here. You can see here we already tested this level right here. So this was a very clear resistance, switch to support here. But now if I'm trading this, and obviously Bitcoin now has been looking pretty bullish, let me put my other indicator here, which is just shading for Mondays. just so I can easily identify where every week starts and ends. But so what I do here is I like to take my rectangle tool. I like to look for the sort of last consolidation before the impulsive move up. And so I have a very clear target here. So now, if Bitcoin would start just having any like bearish price action, maybe you can see we sort of have a little trend line going here. Just get rid of this now. So we have this going. So if I see Bitcoin just having any type of bearish price action, like if we come back here and retest this and start rejecting, and then we start breaking these lows, etc., making lower highs, lower lows, then I know that this is very clearly my first target. All these gap fills are excellent points of target, and if we use our volume profile as confluence, let me just zoom out to get the whole action. Well, we can see it right here. In this case, this target coincides with the bottom of this high volume node, and I would expect some kind of bullish reaction down at this level. So if I'm trading this, if I'm going short on the higher time frames, it will be sort of counter trend, because we're obviously been bullish the last few days, but we can expect to have some kind of retracement. So the way I would play it is I would use volume profile in conjunction with gap fills to look for my entries. If I want even another confluence, I can just put a Fibonacci. So you can see here, you can see how exactly the gap fill would be exactly a 75% pullback on this whole leg up, on this rotation up that we had from this swing low to the high over here. But again, this is sort of a less official form of confluence I like to use. I like to use more volume profile. You can see there's a little cut here too. So like I said, this would be first obvious target down, but this could pull back even lower into this more prominent cuts in volumes, and then I would just look for this to bounce over here. And then in this case, even if we come all the way down here on the higher time frame, this will be a higher low, as you can see here. If we zoom out into a 4-hour time frame, you can see we got low, high, higher low, higher high, higher low, higher high. So now we can pull back into the fill of the gap and then use this as our entry, and then this would be where we can expect a higher low. And obviously when we're trading, we want to look for high risk reward trades, and that's why I also love to use gaps as entries, because they give us a pretty obvious visually, we can very clearly see where our invalidation points are. So in this case, if I was looking to make a trade here, let's put where's our long position here. So let's say if I'm looking to enter here, well, obviously our invalidation, I would put it just below the swing low over here and beyond the low volume areas. We want to use this low volume, this cuts and volumes here as sort of our protections. Let me move this back here. Okay, so then I would just do this. I would put my entry there, take profit. I would at least aim for the previous highs that we had over here. And you can see this is almost a 3-to-1 trade. This would be a very nice trade. I would think this would be a trade that I would definitely think would be a good option to do in this case, using the gap as a entry point, or if you want to, do a little counter trend trade, etc., on a lower time frame, then you can also just zoom in, get more detail, and then you can, well, let me just zoom in here. Let me just get rid of all this. Right there. So then you can see here, like, we can just zoom in on the 15-minute chart. You can clearly see the breakout point here of this consolidation. So any bearish market structure here on the lower time frames, if we just start breaking these lows and making a lower high, or any kind of bearish pattern here, breaking this trend line and then a backwards retest, etc., obvious target here. Okay, so let's see other examples. Let's go into the S&P 500. Let me put my highlight for Mondays. Well, first let's go into a daily chart. So as you can see here, this was the low of the pandemic, but if you just look back here, there's just the low was 2300. You can see back here, if you go back years ago, there's a bunch of gaps and things that have not been filled back here, just breakaway gaps, that have just happened, etc. This was in a massive bull run. Then we have the pandemic low, and then it's just been going up like crazy. This is the pandemic low, and you see we've had a bunch of gaps. There's over here, this is a clear breakaway gap here. From this level, we had this level here, just a breakaway gap right over here. Again, this is the CFD, so that's why we're not showing gaps. If we go to the futures contract over here, you can see that we do have gaps here, specifically most common when it comes to the new trading week. So from a Friday to a Sunday night, when the futures markets open, you can see we do have some gaps that we can observe as just empty gaps in between the things. And then, well, let me just go back here to just show you how I use common gaps in my trading of in this case, futures. So pretty much same concept that I was talking when I was showing you the last example. So for example here, this is a very clear gap that we have here. So I would just mark the area we're at new all-time high levels over here. You can see a very, very clear edge of a high volume node here, which was this areas of consolidation that we had right around these levels. We have the gap here that is yet to fill. So if I was going to mark the gap in this case, well, let's actually just bring this up and mark only the gap. So this gray area, it's pretty much the gap that we have here on this hourly level, which you can see right here. We had consolidation, impulsive move, pull back, but we did not pull back all the way to the origin point of the move. So now I will just zoom out into my intraday charts. In this case, this is a 15-minute chart, or I can go down into my 5-minute, which is the time frame I use. And then over here, you know, any bearish price action or any move down, like here again we have a obvious uptrend here with this trend line that we can use to identify the uptrend. We can see that we're sort of actually another little trend line here. But anyway, so in this case, then the same thing. If I see that this market starts breaking down, etc., then first obvious target to the downside for me after attacking all the swing lows, it's filling the gap here, which you can see is also the top side of a little high volume node. So if we do come down here, I expect some kind of reaction here, but first this would be my first downside target. And if I feel like the structure is still bullish, if I zoom out into the 1 hour, we can see that in this case we have the previous, I'm gonna mark the gap in like a different color. Let me just make it green. And then I will just mark the whole consolidation here as my area that I will look to enter, to just come fill the gap and then just look to continue bullish market structure. From this we could probably come to the point of control here, which as I've always talked about when I do my videos on volume profile, points of control are excellent targets as well. So you can first target gap fill, and second target point of control, up to which point if I was short I would definitely get out in this area, because I would expect a bounce after we have this gap fill over here. And so we have common gaps are seen on any time frame. Like if I go to a 5-minute chart here, this sort of looks messier on a 5-minute chart, but you can see how we get this impulsive moves that are filled back up later eventually. Like here, these ones are still yet to be visited, etc. We can switch to another market. Let's go into Forex just as a last example before I finish off the video. Let's go to Euro US dollar. 1 hour. Okay. And then you can see same thing here. We got gaps, they get filled back, little gap, filled, little gap, filled back, gap here, filled back, etc. So this ones you see everywhere, and then you just use them to set up your levels, your take profits. Like for example here, in this case, I mean, I know obviously this is in hindsight because I'm just like looking at what happened afterwards, but when we have this impulsive move, first thing I do is mark the last. First thing I do here is just mark the last consolidation, the last move up before we have the breakaway out of this level, and then we just push away. And then when we start pushing up, I know that the first obvious area I need to get out is gonna be right at that consolidation before we just pushed out and form the gap. The same on these examples. For example, here we have an obvious support level, clean breakdown, we go out, and then when we start pushing up, very first obvious level to take profits and get out of the longs, or secure at least, would be on the gap fill into the previous level of support, which we now expect to be resistance on the way back. And there's the same thing here. You can grab a marker, just mark the last consolidation, the last move up that you had before the inefficient move in the opposite direction that left the gap in this. Same things here. Some of this take a little while longer to fill. For example, in this case, you can have this one, for example, this impulsive move, which took several days, but as you can see how we just come back in the future, just a perfect test of the gap being filled, small reaction, and then we just continue down here. And this is something also, when you're playing gap fills, this is something that I like to do, where you know, you have the thing, the impulsive move, then when you come back, you know, in this case, you say, okay, we made higher highs, I want to play and try to fade this. If you are short, you close and take profits, but if you're trying to get long, you wait until you come into the consolidation just prior to the breakout here, you come and you bounce. This, you should get a pretty strong reaction right away. Ideally, you just want to see the candle, whatever time frame you use for trading. Let's say we're using the 1 hour. You want to see ideally just a wick and like a pin bar hammer or something, like a strong close, and then you want to see price moving away from here, confirming that this was a higher low. If this just starts coming right back into it, that is not a good sign. You just want to kill the trade and get right out, because like here we had a little bounce, but all we did in reality was filled this micro gap that we had right here back into this support level, broken now resistance, and we just keep pushing down. But that's the good thing about not chasing price, because here, if you waited for price to come down to your level to enter, and let's say you entered the trade here, let me put a long position. Let's say you waited and you got exactly here, and this, let's say you were targeting, I don't know, the previous high and your stop loss, you had it set. In this case, I mean, this is kind of hard with this wicks. This is not like a very nice price action to like try to get in. Let's say that you put it right there, just below the last move down here, 2.5 R&R, which is decent. So then here, if you're getting here, but then you see immediately it's coming down here, you can kill the trade here for like a very small loss. Whereas if you just try to, chase along anywhere up here before your gap is filled, you're gonna just screw yourself in terms of your risk reward of your trades. You want to always go in when the gap is filled, and using your volume profile also. Well, if you use it, which I advocate I use because it's my number one tool that I always talk about, going in on the extremes of low volumes. Okay, so I mean, I think that's pretty much it. I just wanted to share with you my thoughts. Again, this was just sort of an improvised video showing you how I use common gaps to set my intraday targets, and also how I look to get on trend pullback entries into the gap fills to get in on positions. Okay, if you got any questions or comments, leave them down below. Make sure you follow me on my social medias. Again, if you haven't done so, do me a favor, hit that subscribe button, hit the like, share with all your friends. You can go check out my website for more information on all my trading courses and more in-depth explanation and just theory of everything I know with regards to trading, price action, volume profile, and using gaps in my trading strategies as well. Okay, I will see you all the next time. Take care, and thanks for tuning in.